Stephanie Hughes of Bloomberg joins us now. Stephanie, thanks so much. You got your eye on Brookfield Renewable?
That's right, Andy. Happy Friday. So Brookfield Renewable shares rose as much as 8% today, which was the biggest intraday gain since late October of last year. That's because the investment company reported earnings earlier today where the revenue of $1.43 billion exceeded analyst expectations. The company added that the outlook for clean energy has never been stronger as corporate clients are looking for low carbon source energy to fuel data centers and for electrification. The company added that the new U.S. administration's investments in the space is helping to drive that growth further. So J.P. Morgan analysts say that the trading premium on these shares is justified given the diversified portfolio that this company has and its strong position in this growing market there, Andy.
And what's your other stock on the radar? Now I'm forgetting Rogers. I'm sorry. Yeah, there's concerns over the debt load. Thanks.
That's right. So, yeah, those shares are down as much as 4% today. Yesterday, they completely broke the trading day even, but today they erased about a half month's worth of gains. And that's because of their lowered guidance and because of debt loads. So I want to highlight this Morgan Stanley report where the analysts trimmed their price target on the telecom giant, pointing to the subdued guidance where they expect EBITDA for the full year will either be flat or rise as much as 3%. That's down from double-digit gains that they enjoyed last year. They also said that they're keeping their underweight rating given the debt leverage concerns and the uncertainty around this structured equity deal to help them with that debt load as they pursue the Maple Leaf Sports and Entertainment stake sale from BCE there. Mm-hmm. So the target was cut by $4 to about $41 there. So I usually read notes from Canadian analysts on telcos there, but it's always interesting to get the outside perspective. Morgan Stanley said that relative to U.S. telcos, Canadian companies have slower growth and debt problems, which means that the fact that they trade at a premium makes the risk-reward level a little bit more skewed to the downside there, Andy.
That is interesting. Of course, Rogers does compete with our parent company here, BCE. And I'm just looking over and the telcos generally have been out of favour. Over the past year, Rogers, this is excluding any dividends, is down about 36%. So is BCE. And TELUS is down about 13%. So that whole sector has been, a lot of investors have walked away from it. But it's interesting to hear that comment from Morgan Stanley. Thank you very much indeed for joining us, Stephanie.
Thank you.
And have a great weekend as well. And our best regards to the iguana. Hope she's well. Up next, the closing bells on Bay Street.